Joining me now with more about everything moving markets, including trade, inflation, and of course, where the Fed is heading is Art Hogan. He's a chief market strategist at B. Riley Wealth Management. Art, always good to have you on the show. And let's start with this inflation data today. What does it tell you about the economy?
Well, I can tell you this. One of the things to think about is the effects of tariff pricing really haven't shown up in goods price inflation just yet. And I think that was true last week with the PCE and certainly this week with the CPI and the PPI. I think if you look at the spectrum of the basket of the PPI, in general, we didn't see much pressure coming from the goods price inflation, but there's been some offsets too. So shelter cost has come down a bit. Finally, owner's equivalent rent is breaking down a little bit, something we've been waiting for a couple of years. I think the other piece of the puzzle is that we'll likely see that start to tick up in goods pricing in the months to come. It hasn't shown up yet. So the good news is we're starting from a lower base. There's less inflation pressure, but I still think that keeps the Fed at bay until the September meeting.
Interesting. And we are going to get that Fed decision next week, Art, so I'm glad you brought that up. Let's talk trade. It is stealing the headlines, as always. President Donald Trump threatening unilateral tariffs, and Treasury Secretary Scott Bessent floating the idea of extending the tariff pause for countries that are in good faith when it comes to trade talks. How is that showing up in the markets?
Yeah, I think the market's gotten around to a consensus that will likely land somewhere at 10% universal tariffs, somewhere around 30% for China. I think that's going to play out through the month of July. This is a self-imposed deadline that the administration put on themselves is July 9th, end of the 90-day negotiating period. But I think if we look at UK as a template for what the rest of the world looks like, that's likely where we land. And the market seems to be a lot better with that than they were with the August 2nd Liberation Day rollout of reciprocal tariffs, which just was chaotic and didn't make a great deal of sense. The problem with all of this is that the average tariff on imports now will go from 2.5% to closer to 16%. Some 15% of that will be taken in by the exporter, about 15% will be taken in gross margins, but that means 70% of that increase on average is going to be paid by the consumer. That will show up, and a drawdown in demand and probably some economic slowdown, economic data slowdown probably shows up more in the third quarter than in the second quarter.
Interesting. So what does this mean for the economy going forward, Art?
Well, first and foremost, I think we had a pull forward of demand in the first quarter for all sorts of things, both by the enterprise level and by the consumer level. And I think that likely shows up in a slowdown in demand in the second and third quarter. So we'll need to wash through a lot of that tariff-related data from the first quarter. Likely won't get out of that sort of noisy economic data until the fourth quarter. We'll likely see a third quarter that's slower than the first and second quarter because of that and because of the increase in prices. But we'll likely have washed out a lot of that by the fourth quarter. So I think by the end of the year, we'll be in a better place than we are in the middle of the year. So we're coming into that bumpy period of economic data where it's going to be hard to differentiate what was some pull forward of demand that's causing a slowdown in demand. You think about it like this. You bought a refrigerator in March. You're not going to buy another one in July or August.
Yeah. Okay, so a good context there for the economy. Now, how does that translate to action in the stock market as we do see the S&P 500 just about 2% from its all-time high?
Well, I think the market's very much of a forward pricing mechanism, and the market certainly voted about the Liberation Day tariff release by quick two-day 10% drawdown. In total, we were down about 20% from peak to trough this year. We've recovered most of that, and we're now up about 3% year-to-date on the S&P 500. That's probably where we should be for the time being. What we need to see is the second quarter earnings reporting season when we'll finally get some guidance from companies. Companies will be able to say, we've modeled out what our input costs are going to be now that we know the rules of the road with trade. And I think that will drive a lot of the action into the end of the year. It's what does corporate America say? How will they be affected? How will they mitigate some of these tariffs? And what will that mean for consumer demand? I think that the market likely is at a good place right now, having recovered most of its April losses. And now we probably grind higher with the incremental new news really coming from the second quarter earnings reporting season.
I do want to talk about the Fed. You mentioned, Art, that you see the next Fed move in September. We'll have two meetings before that, one next week, and of course, one at the end of July as well. What does Jerome Powell need to hit on in his press conference and in that decision next week that'll give us a little bit more clarity?
I think the three things he needs to address, I think one is how they think about the one-time price increase of tariffs with what they know right now. The second thing is why it is they feel comfortable waiting for data to come in as opposed to going ahead and becoming less restrictive with the Fed funds rate. Right now, if you look at the Treasury curve, The 2-year is trading below the Fed funds rate, which doesn't typically happen and usually signals that they're too restrictive. I think the third thing really is what would drive them to make their first move. And I think that really sits at the feet of the unemployment rate. So we've seen the weekly jobless claims, including today's, inch higher over the course of the last 4 weeks. We were averaging about 220,000 for the first quarter of this year. Now we're averaging about 237,000, and that likely picks up. As that picks up and we start creating fewer jobs on a monthly basis, unemployment's going to tick up, and that's really what the Fed looks at for the mandate that they're trying to defend, and that's what would make the Fed actually cut rates, and probably not until September.
Interesting. We will be watching that in September. We are getting some earnings. Oracle better than expected this morning. We like to see that here at the stock exchange. But IPOs happening again here at the NYSE. Do you think that's a vote of confidence?
I certainly do. I think the combination of the IPOs that have all been successful, the window clearly back open, corporate America feeling more comfortable in making mergers and acquisitions. And I think all of that sort of plays into the fact that I think corporate America feels more comfortable than they did in the first quarter, right? They're more comfortable around the end game in trade. They're certainly more comfortable about Congress's ability to extend the Tax Cuts and Jobs Act of 2017. So the environment heading into the second quarter and the third quarter likely is a lot more confidence than we had in the first quarter. And I think that's reflected in the fact that companies are willing to come public, companies are willing to do M&A activity, and I think we're going to see a whole lot more of that into the end of the year.
Art Hogan, Chief Market Strategist at B. Riley Wealth Management. Art, thank you.
Thank you.